Okay, welcome everybody to today's session on SMSF Trust Deed Updates. My name's Aaron Dunn, and again, thank you for joining us on what would be relatively short notice for our webinars, but we thought it was an important topic to make you aware of and get you up to speed with, as these are conversations that you really need to start having with your clients. Joining me today is my business partner and co-founder of the SMSF Academy, Ian Glenister. So welcome, Ian.
Thank you, Aaron, and good afternoon to all of our listeners.
So today's session, like I said, is to help you understand just why it is important to look at the rules of your fund or the rules of your client's funds and work out the implications as to updating trust deeds. And I guess as we start, Ian, today, when we think about the SMSF governing rules, there have been particular events since the inception of SMSFs where, in essence, a whole of replacement really needed to occur. Sure, we've seen some things along the way. So we've had the introduction of the limited recourse borrowing rules, and we know that there'd been updates required for that back in 2007 with instalment warrants, and again in 2010 under the LRBA provisions. But they weren't something that all clients needed to do. So can you maybe take us through this initial slide around these significant events that have really meant that we had to see the rules of the fund, in essence, updated to facilitate the continued operation of the SMSF?
Okay, well, 1999 was the major introduction in many respects of the actual SMSF concept.
Yep.
When self-managed super funds came into operation.
Yep.
Okay. Then, of course, there was the massive upheaval as far as legislation was concerned with the introduction of simpler super on the 1st of July 2007.
Yep.
And at that point in time, I completely rewrote the trust deed that I provided for clients. It wasn't a cut and paste job as far as what a lot of providers did. I sat down and spent many hours laboriously going through and writing a whole new trust deed for the simpler super legislation.
And many of those pieces, I guess, still continue to exist today because we saw caps and, rather than, no real limitations on contributions, because we had RBLs, didn't we, at that point in time?
Correct. Then, of course, the introduction of the legislation as of last year, which is to come into effect as of the 1st of July this year, and that's been another massive upheaval as far as legislative change is concerned, because post 1 July 2007, we had reasonable benefit limits. I submit that as of 1 July of this year, we've gone back in time 10 years with the transfer balance caps. We are having the federal government say to superannuants, this is the amount of money that you can take into retirement with you, the maximum amount, to obtain a pension benefit income. So the changes in 2017 are just as magnanimous as the changes that took effect in 2007. And that's why, in concert with yourself and another lawyer who's in the SMSF space, Chris Hill, you and I and Chris spent an inordinate amount of time completely dismantling the deed and then putting it back together to make sure that it adhered to every piece of legislation that is going to come into effect as of 1 July next.
Yeah, so I guess when, and many of you that have maybe been on training sessions that I've spoken about in recent times around capitalising on the contribution reforms and so forth, talked about this once in a decade opportunity. And it is very much, when you look at the timeline here, that these sort of events do come around, in 10 year cycles, which is typically a time frame that a government's actually in government for too, when you think about it. But what we really want to share with you today is to understand the nuances between how a deed is crafted. And this is, Ian, where I want to, I guess, get your insights for our audience today, insofar that many of the changes that we are seeing here are really impacting the Income Tax Assessment Act and the Income Tax Assessment Regulation. So we're seeing the introduction of transfer balance caps, and the CGT relief is, even though it's transitional, into transitional provisions. It is all income tax context. When we see the impact on the SIS legislation and the regulations, there is very little change around the operation of that. We have seen currently some draft regulations, or in the exposure draft, around the removal of fund cap contributions, which we know sits in SIS Reg 7043. But what impact does this have on a solicitor drafting the rules of the fund when we look at the nuances between it impacting the Tax Act and regs versus the SIS Act and regulations?
Well, I think first and foremost, Aaron, when clients are confronted with the issue of, and I'm talking the clients at the coalface, the members of self-managed super funds, when they're confronted with issues in respect of trust deeds, there seems to be a reluctance to upgrade their trust deed for whatever reason it may be, even though it's a very nominal expense to the fund. I like my motor vehicle to perform at its optimum performance. Yeah. That's why I regularly service it.
Yeah.
Now, analogously, that's exactly the same with respect to reviewing and upgrading your trust deed.
Yep.
Because the clients and the advisors will want their clients' funds to perform at their maximum performance.
Yep. To achieve, I guess, the sole purpose of obtaining the retirement benefits that they want to achieve.
Exactly. And as opposed to referring to their clients' trust deeds as trust deeds, which in some respects is a little bit scary and spooky for some clients, I always talk about the book of rules that governs the operation of the fund. Same thing, book of rules, trust deed. In respect of the most recent legislative changes, from a superannuation fund trust deed upgrade perspective, it's very simple from a legal perspective. If it's not in the rules, you can't do it.
Mm-hmm.
And if the most recent legislative changes, for example, in respect of contributions, isn't in the book of rules, well, you can't adhere to and provide for the legislative requirements that will come into effect as of the 1st of July next.
Yep.
It will also, clients won't be able to instigate a number of other strategies that you've already qualified with a series of your webinars to our Academy members and other attendees. Those strategies are engrossed in the deed. They sit inside the deed, and it enables the members to maximise those benefits.
Yeah.
And we'll talk about a number of the other issues that we've developed as a result of the upgrade and amendments to the deed that you and Chris Hill and I undertook that will benefit the members.
Yeah. And so when we look at and again, this is, I guess, getting down to the legalistic elements of it, but when you look to draft the rules, you generally want the rules to be scripted quite broadly insofar that it will allow for certain actions to take place. The ability to commence an income stream, as long as the income stream commences, doesn't prejudice the complying status of the fund, et cetera, et cetera. And that's why you see guides inside there as being critically important, because it helps to unpack a lot of the legal terms and the legal operation of the deed in itself. So can you explain that concept?
One of the things that I endeavoured to do when I drafted the deed initially, and it's something that Chris Hill and I have always mutually agreed needs to take effect, and that is to draft the deed in plain English, in language that the advisors and the members of the fund can understand. However, regardless of how plain the drafting can be on occasion, there are times when legalese comes to the fore, unfortunately. However, the one thing that we have with our deed, of course, is at the beginning of each rule, there is a summary of what the rule actually deals with in essence.
Yep.
And that summary is written in plain English. Anyone can read any of the summaries, and I would defy someone to say, oh, I haven't been able to understand the summary because it's too legalese or it's too complex. That's the idea of having a deed that gives the opportunity for people to understand what they're doing.
Yeah, and I think a good example of that is the contributions guide, where at the back end of it we talk about the fact that you can, the rules of the fund actually cover the ability to do things like concessional catch-up contributions and the ability to apply the small business concessions in respect to certain contributions made by individuals. In addition to, the ability to do contribution reserving or whatever it may be. But whilst you might not see that specifically in the rule itself, the guide then captures the strategic decisions or ways in which you want to apply strategies with your SMSF clients. So I guess in many instances, you're not going, a drafted deed may take a very broad approach in certain elements. And I guess then, Ian, the way in which you also deal with certain aspects of that deed is to then allow for the deed to create other special rules of the fund. And a very good example there is, say, the commencement of an income stream. So whilst the pension, whilst the rules allow for a pension to operate, we can then also embed those resolutions in commencing the deed as a special rule of the fund. So why do you see that as an important tool?
Well, because it qualifies in definitive terms, not only the legislative provisions, but also the practical provisions of the payment of the income stream.
Yep.
Because a member may determine that they want to be paid weekly, want to be paid quarterly, they might only want to be paid once a year. So it's the qualifying documentation that's led from the deed that then qualifies the manner in which the income stream will be paid.
Yep.
Just one issue that I thought I'd add here too, Aaron. As you know, I have a large estate and succession planning practice, particularly in respect of SMSF. And the number of times it's astounded me where I'll be dealing with clients who are receiving an account-based pension and their trust deeds dated 2002.
Yeah.
And I scratch my head and think to myself, how can you be receiving an account-based pension if the governing rules of the fund don't permit it?
Yep. Yeah. And in essence, that's really why it's the servicing of the car to ensure that you can do the strategies that need to happen.
And we're not talking a lot of money here.
Yeah.
Right? I mean, if I had a combine harvester and I service it, it might cost me a couple of $100,000 now, or whatever it might be, and it's worth, I don't know, nearly $1 million, that machine, okay? There are clients who have millions of dollars inside their super fund, and we're suggesting that they pay less than $200 to service it.
Yep.
I mean, it's a nonsense not to do it.
Yeah. And in many respects there may actually be rationale in some instances to have you are actually servicing a Ferrari or a Maserati, so you do need some specific tools and skills to be able to service that, as opposed to something that is more mainstream. So let's move on now, I guess, to some of the changes we've made, but I guess more importantly, whether you want to use our deed that we have or whether you're looking at deeds more broadly, these are some of the things that you need to be giving consideration to, because what we've done in the first instance is looked at this change to what is an authorised contribution. And when we look at the contribution rules in themselves, we've introduced the requirement that we have a qualification criteria for the individual to be able to make the contribution, because what is now going to occur is that the fund capped rules, so the ability for a super fund to limit any acceptance of a contribution is going to be removed. And the reason why that is going to be removed is because it's not the fund's duty to understand whether a member has a $1.6 million balance or not, because you could have it across multiple funds. So the burden of proof is going to be back onto the individual to be able to work out whether they are eligible to make that contribution. So we've put in place there a qualification criteria. The fund is still eligible to accept any contribution now that is made, not being restricted by any fund capped rules. But we ensure that the qualification is insofar that we have this now operation of the general transfer balance cap. And you can see up the top there are some terms that now need to be added in. For example, a default commutation notice, where an individual has breached their transfer balance cap, they will need to comply with the notice that is actually provided by the ATO. And we have had in the deed for some time the excess contribution tax rules and release authorities and so forth. So that needed to also be incorporated in here. What's also important is we need to understand and distinguish between the transfer balance caps. Sure, we have a general transfer balance cap, and we know that that starts at $1.6 million, but each member will have their own individual transfer balance cap because of the proportioning requirements of indexation due to amounts that they may have already credited into their transfer balance account. So distinguishing between general transfer balance cap, which impacts not only retirement phase income streams, but also qualification for contributions. We've also introduced the concept of retirement phase because off the back of retirement phase, it is the enabler for income tax exemption. The concept of a transfer balance account is something that we're all going to have to deal with now because of the reporting obligations. And we'll come back to that last one, but we've also built in this concept of a paramount document. And this will help to distinguish between what documents you may wish to have priority with when it comes to whether, say, a binding nomination or a reversionary pension is to take precedence. So, Ian, is there anything you want to add off the back of some of those initial changes, in particular definitions and then the contribution rules?
Now, one thing I'd like to add generally, Aaron, is that there seems to be some form of urban myth that unless my client is going to fall within the confines of a transfer balance cap come 30 June, there'll excuse me, there'll be no necessity for my client's trustee to be updated. Okay. Yep. Well, I'd like to squash that urban myth in definitive terms, because what we're talking about now and the issues that you've just sort of scratched the surface with here now, and we'll go through in more definitive terms during the continuation of this webinar. Any member of a self-managed super fund as of the 1st of July this year, their trust deed must be upgraded to deal with the new legislative requirements.
Yeah. So the qualification, for example, to be able to make contributions,
correct,
whilst they might not be at a stage of making pensions, they need to ensure that they qualify to be able to make that non-concessional contribution.
Whether they're 18, 28, 58 or 68.
Correct.
They need to upgrade their trust deed.
Yep. Yeah. So there are requirements in here that need to be adhered to. Yes, broadly speaking, a lot of it impacts retirement phase, but equally we are seeing changes that will, with the transfer balance cap, that also impact contributions. What we've also done is we've updated the area around reserves in two parts. First of all, the fact that from the 1st of July 2017, there will be no eligibility to continue the use of anti-detriment payments. So the functionality of an investment, of an anti-detriment reserve will in essence cease unless We do have transitional arrangements for pre-existing anti-detriment reserves where a member dies prior to the 30th of June 2017. What we've also done is we've updated some wording around the use of investment reserves, because I think over the course of the next few months and more, as we keep disseminating information, not only through legislation, but also through interpretation with the ATO's Law Companion Guidelines, I think we'll see investment reserves get looked at and explored in some detail as part of longer term succession. So again, we've just tidied that up to make sure that the purpose and intent of why we may look to use an investment reserve would suit the type of strategies that we'd be looking to do. The SMSF estate planning there, one of the things that we've done here, and we've had some quite extensive discussions amongst myself, Ian and Chris, around the estate planning aspects, is we've streamlined, not so much with the regulations, but we've streamlined the need for acceptance of the death benefit nominations by the trustees here when it comes to binding nominations and non-binding nominations. So we have prescriptive schedules in the back of the deed that deal with death benefit nominations, but once that's been submitted, it is in essence automatically accepted. Now that is distinct and different, however, to the concept of the SMSF Will, and we'll be working on that throughout the rest of the year to potentially include that within our campus platform as well. So Ian, do you maybe want to cover off anything else in respect to Rule 11?
Something that's very close to my heart is the SMSF estate planning, and I think it's extremely important to put your advisors on notice that SMSF estate planning, with the introduction of the transfer balance cap, is just going to become enormous.
Mm-hmm.
And the manner in which the excesses of the transfer balance cap will be dealt with from an estate planning issue. Blended families where both the husband and wife, or the lifetime partner or whatever, have got excess transfer balance caps, or they have a certain asset that they want to pass to one of their blood lineage relatives. And I'm only scratching the surface here as far as SMSF estate planning is concerned. And the other thing that I've noticed with some disdain in many respects is the times that I've seen that dealing with SMSF death benefits in isolation away from the other estate planning elements of a client, their personal assets, the assets that they control in trusts, the assets that they have in companies. Estate planning should be holistic, inclusive of SMSF. Times are now, Aaron, where the accounting profession have encouraged, and why not, people out there to have the vast majority of their wealth inside superannuation because of the tax benefits and the income stream benefits. So dealing with SMSF estate planning is absolutely crucial from a holistic estate planning perspective.
Yeah.
And I would suggest that it's, in some respects, a nonsense to deal solely with death benefit nomination or an SMSF will or pensions
yeah.
or whatever,
yeah.
without having a review of how that will all plug in to the balance of the client's estate plan.
Yeah, and again, we've raised there this concept of Paramount document, and we will come and explain it shortly, but it's this disconnect is the reason why we've come up with this concept, because we're trying to actually get people to go, well, actually, do we want this thing to be the overarching decision tool for the estate planning? So it's getting you actually thinking about, well, do we have pensions? Do we have estate? Do we have a binding nomination, non-binding SMSF? Well, what is it? But which is the one that we want to take precedent against all of the others?
And the other issue too, I think, my observations are that there's a propensity with your financial planners and your other advisors in respect of SMSF to deal with, while their clients are alive, what are their investments doing? What are their returns doing? How's their pension going? Are all their compliance issues up to date, etc., etc.? But what about when one of them dies? What happens then to their superannuation interest?
And the transfer balance cap now, the fact that you've got limitations as to what that individual can have may actually mean that there's assets that need to be either liquidated or transferred out of the fund simply because there's maybe some or no ability to actually retain that money in super because of the new cashing restrictions that have been introduced.
The good old days of when the husband died, his pension automatically passed to the wife, so she had two pensions, totaling who knows how much, but usually well in excess of whatever amount of dollars. Okay, and it certainly would exceed the transfer balance cap. We've seen that on innumerable occasions. Those days will be gone as of 1 July. So if the husband dies, what's going to happen to his 1.6 million? Because the wife already has 1.4 million sitting in her pension account.
So there's decisions that need to be made around the commutation and lumpy assets and the like. So let's keep moving. So Rule 11, we've just made some changes around just the record keeping requirements. We've just made sure that that aligns into, I guess, what the ATO has within their record keeping records and stuff online. And that covers, I guess, right through to things like the CGT relief. And then we've also ensured that reporting by trustees incorporates market valuations of fund assets as well. So again, these are just little things just to make sure we continue to line up. We go into Rules 19 and 20. Again, the introduction of some of the additional definitions. So when we're accounting for a member's accumulation interest, where the ability that we can add or remove amounts from those types of interests, whether they're for amounts that need to be paid in respect to excess amounts. We've got potential rollbacks out of income stream interests that can come back into member accumulation interests and the like. The same then applies for those super income stream interests, where again, there may be some excess transfer balance amount. So under a default commutation notice, the member needs to be able to move that money from the income stream interest back to the accumulation interest or potentially out of the superannuation fund. And then finally, we've then also incorporated all the changes around the excess transfer balance tax rules that then also tie into the existing excess contribution rules that we have in there that deal with not only excess contributions and release amounts and the like, but also now excess transfer balance amounts where we have the breach above the general transfer balance cap or more importantly, the members' transfer balance cap. Rule 25 is one area, Ian, I think we want to touch on a little bit more because this is, in essence, where a lot of the changes have occurred.
I think this is the paramount rule and the paramount issues that advisors need to be au fait with.
So here, Rule 25 covers off the accessing of member benefits. So we've done obviously a complete overhaul of the guide that looks at the transfer balance cap issues and it looks at the payment, what happens in the event of the death of the member and so forth. As we touched on earlier, the way in which the deed has been drafted allows for income streams to be special rules of the fund. So what this does, and the reason why this is important, is because it establishes a range of terms and conditions in respect to the payment of that income stream. And those terms and conditions sure need to comply with 106.1 and more specifically 106.9a if we're looking at an account-based pension. But we could then introduce additional rules as long as we don't prejudice those payment standards in 106. Importantly, and we did this change probably middle of last year or maybe a touch earlier, is that the fact that these terms and conditions may need to be or want to be altered over the course of the payment of that income stream. So that because we have attached to this as a special rule, terms and conditions, we can in essence change the terms and conditions of that pension midstream. And there are a few important reasons why you might want to do that. The first one may be that you want to be able to add or remove a reversionary beneficiary. Previously, it's been, well, do we commute the pension and restart the pension? And sure, you can look at that as a strategy, but by the same token, you may have a range of clients that are Centrelink entitled by virtue of their age pension, but are pre-1 January 2015 income streams. Therefore, those pensions are grandfathered under the old deductible amount rules as opposed to the deeming rules that apply today. So by adding or by removing a reversionary beneficiary there does not change the grandfathering status of that income stream. The other key area which we've seen is around potentially the level of reversion that you want to introduce. Ordinarily, we have a pension that could be 100% reversionary, because if I state that in the event of my death, that pension is to revert to my wife, Nat, it's meaning that it's in essence 100%. But there may be circumstances whereby you want to nominate that percentage or amount of reversion to that specific reversion rate. So changing that midstream can be important, and also that you want to state that income stream where appropriate to be the paramount document. So Ian, do you want to shed anything further on that topic before we move down to some of the other areas?
No, I think the manner in which we've amended Rule 25 is it gives maximum flexibility to the operation of the new legislation.
Yep.
You know, the members' shoes aren't stuck in concrete with respect to the various income streams and the manners that they can access their superannuation benefits.
Yep.
But if I may move on to the next paragraph, the ability to pay conditional pensions for blended families. That's something that we introduced a number of years ago. It's been extremely beneficial for the ability to be able to have a second husband to pay an income stream to a second wife that's non-commutable. She doesn't have any access to the capital, but then at the time of her death, the husband's superannuation interest reverts to his estate, and then of course passes to his children. And of course the same goes with a wife with a second husband, or they don't have to be married, they can be life partnered, but the ability to be able to quarantine a blended family's capital from a superannuation perspective because they want it to go in the direction that they want it to go, as opposed to it being directed subsequent to their death.
Yep.
And of course, the conditions and the terms in respect of the conditional pension are all documented. Each of the members of the conditional pension documentation, as it were, have the opportunity to seek independent legal, financial and tax advice in respect of the documentation. But it's something that's quite extensive to our deed, Aaron, to the extent that there have been occasions that I've noticed that there are other providers out there who have obviously determined to follow our lead, as it were.
Yep. So I think, and just to finish off on this area, of course, then what we've also incorporated is to look at and take advantage of many of the key strategies in terms of how those benefits can be paid. So at the moment, the ability to do elections, to be able to treat amounts as lump sums rather than income streams and the like, all flow through here in the deed at the moment, and will accommodate the changes around those elections from the 1st of July. So the ability to still do rollbacks and partially commute income streams, the ability to roll over income streams now, so death benefit income streams will be important, and whether that amount is to be paid as a cash rollover or an in specie or combination thereof can also be accommodated throughout the deed. And finally, the fact that we have introduced reporting requirements, again, will just ensure that the trustees have maintained the appropriate reporting in respect to those income stream benefits as well. The other items here, which I think are also important, is we do have the ability to adopt a different way of attributing earnings to a member. Now, this might not look like much, and this is something that's been in the deed for some time, but what we've done long term is we've applied a proportionate approach to the way in which we attribute earnings. And that has very much aligned with the way in which we apply earnings in a tax context. This may be something that needs to be explored into the future, in particular where there is going to be prohibition of segregation where a member has balances in excess of the $1.6 million. Because what we will be able to do in the future is there's nothing that prevents or precludes us from running separate investment strategies within a fund. It's in the covenants in 52F of the SIS Act for SMSFs, but we won't be able to, for income tax purposes, apply a segregated approach in respect to those specific assets. So broadly speaking, I can set aside specific assets as part of the investment strategy into an income stream or accumulation members, but when it comes back to the tax return, we need to throw it back into one pot and determine the tax exemption. So the methodology that we might want to use may be different when we look at the allocation of fund earnings. So the ability to look at different methods that we want to use, including where we may want to be looking at reserves, is something that the deed gives consideration to. One of the other areas that we've spent a bit of time on updating, and again, this goes through as a special rule of the fund, is we've made changes to update for QROP status, which will introduce, of course, some restrictions on membership by virtue of age with the UK, I think it's Pension Act over there. So again, it will create a range of additional resolutions and the like that will become a special rule of the fund. And of course, the final thing is that we've updated the PDS quite extensively. That's almost had a rewrite itself to reflect all the changes from the 1st of July 2017. Now, Ian, what I want you to do is to now talk to this concept now of the Paramount document.
Okay. As you put on the slide there, a Paramount document is a document or an agreement that's created by the members of the fund that gives a specific direction to the trustee that supersedes anything else that the trustee's been told in respect of the payment of the members' benefits,
yep.
Whether it be income stream, whether it be pension,
Yep.
or whether it be a death benefit.
Yep.
Okay, because there may be occasion where let's say an SMSF will or a binding death benefit nomination may be difficult to interpret in some respects, but if the member qualifies that this is the paramount document, and at the time of my death, that this is the manner in which the death benefit has to be paid, that's a special rule of the fund, and definitively the trustee must adhere by that special document.
Even where it's in conflict with the fact that that pension may have been stated as being auto-reversionary to another dependent at that particular point in time. And this is where we go back to the conversation that we were having earlier. It's that it's trying to get you, the advisor, focusing on some of these issues. What is the document that is to take precedent in the eyes of your client? Because you don't want to end up in situations where you are unsure as to whether one document takes precedent over another document, whereas this ensures that one has taken precedent over the other. And we've made changes to, I think, also the definition of death benefit as well, to ensure that, if the reversionary does continue, that consideration needs to be given to the Paramount document to allow to work out whether that is actually auto-reversionary or not in its own right.
I think it's the issues that you've just expressed must be explored by advisors with their clients. Because once it's done and it's done properly, it's set in stone. It doesn't have to be revisited. So, you know, I go back to my comments earlier, particularly the payment of superannuation death benefits. I simply don't think it gets the attention it deserves.
Yep. So that's why I guess we've introduced that paramount document concept, and again, it's there to ensure that people try and do that as best as they possibly can. So they're the key areas that I want to touch on. What I did also want to say, and this goes back to where we talk about capitalising on the reforms in some of the sessions we've done recently, is in today's day and age, we want to be able to not only look at the veracity of our documents and ensure that we're covering off on all the strategies that we want to cover off. We also want to make sure that we can do this in a seamless way as we can possibly do so. And this is why we think within the SMSF Academy, our campus platform allows you to go through a process like a deed integration in a very quick period of time. So what I want to do is I want to quickly show you the campus area, and then we of course have our documents area here. You can see we can filter down and find our deed update. That just summarises the information. You can see videos and the like, and it will then take you in and do that deed upgrade. So yes, it's a very easy way to go through and put the information in and track what you need to do around deed history. But if you have this information inside your SMSF software, Simple Fund 360 or Class Super, this is where you will leverage the benefits, because you can pick up the name of your fund, you can put in the clause or rule that allows for this update to occur. So if we say it's clause 85 of the existing one, we are then importing that data, and I'm going to do the same thing on the class import as well. So in our integrations and add-ons, we simply go to the specific one, and then you can see that all of this information is populating through. So we have one quick question to ask here around CUROP status, if we're updating for CUROPS purposes, because we've had requests for that. Then we're looking at literally going through and making sure that we have all the information in here that we need, and then we have all the other information that is automatically populated here around who the trustee is and the like, who the member details are, and then we can simply go and submit. So again, this will be a function of whether you've got all of the information in the system or not. And then as you can see here with the Class Super one, again, we can do the same thing, deed upgrade, and then review and submit that information. So we have that main information there, and then the same one we're in here. So we can go in and we can actually find our fund, rule and clause, and then do it very quickly and easily. Review the information, and then we can apply a coupon code or subject to different levels of membership. You would get access to this, and then you would simply place your order. So that's how you want to be able to now use efficiency to ensure that you get these deed upgrades done as well. So again, the same thing here under class. No, has it been previously amended, yes or no? If that data is inside the software, which you should be tracking that information, that will all automatically populate. And then again, we're going through, reviewing the screens, and then being able to submit. And that deed and documentation will then be readily available for you to arrange for the client to sign. So that's the type of process that you want to be trying to obtain inside your practice. So taking advantage of the technology.
While we're on that point, please advisors, have your clients sign and date the upgrade.
Yes.
Okay. I've dealt with a number of trustees that have been dated, only signed by one member. I've had trustees that have been dated and not signed by any members. And then I've had trustees that have been signed by either one or two members and not dated.
Yep.
And on all cases, those deeds would be unenforceable.
Unenforceable. Yep. So I guess what I just wanted to show you is how simple that process can be. And then here you will have the ability to download that document and then access the actual deed upgrade itself. So you can then see here we have our deed of variation, we have the specific variation itself, and then behind that we will have the actual deed, and then obviously all the rules that we've been talking about today in terms of those changes, and then we move into the product disclosure statement, et cetera, et cetera. I think this one here as well, we've got the actual special rule where we've wanted to apply for cure-op status as well. So these are the things you need to, in essence, be looking out for, taking advantage of the technology that is also in play at the moment as well. So again, you can see just how quickly we're able to generate those two. So what we just wanted to do in finalising today, we do have our deed updates and so forth that are now readily available. If you want to look at using this on a per piece basis, you certainly can do so. We have this available for you to use. You can take advantage of that for the rest of this month. More importantly, and this is what we are seeing many of our members do, not only at our gold level membership, but even at our lower levels of membership, what they're doing is taking advantage of upgrading their existing SMSF Academy membership. And what we are putting in play is the ability to, in essence, set up periods of time based on the number of funds that you have to effectively amortize the cost incurred of, I guess, upgrading your SMSF trustee. So if you fit into any of those categories, I would suggest arranging a telephone appointment with us. We can have a discussion with you around the membership platform and what you can do to not only access the deed itself with all of your SMSF clients, but also take advantage of some of the integrations that we have there as well. We've also built out some letters to clients that you can use to help explain the process and why the deed needs to be upgraded as well. So if you want to book an appointment, you can do that there. So bit.ly/trustee update. It was way too long to put on the screen. I will add that to the chat area as well, which you can do, and you'll be able to access that with either myself or one of our team members. I will be travelling a little bit over the course of the next few weeks, but all of our team here are here and ready to actually help with any inquiries that you might have around that as well. So you can book that appointment, like I said, and then get that locked in and have a discussion with us about the benefits of our membership. So Ian, in closing, what would you like people to take away most importantly from the need to look at the trust deed updates for your SMSF clients?
Well, I suppose I've only got one simple message, and that is if you have a self-managed super fund,
yep,
the deed needs to be upgraded.
Yep.
I mean, I'm a member of a self-managed fund, and I've already done mine. Make sure the clients are aware why this has to be done.
Mm-hmm.
And I think in simplistic terms too, we're not talking about a great deal of investment here.
Mm.
It's a nominal fee to make sure that the client's fund can operate efficiently, effectively, and to adhere to all of the amended legislation that will come into operation as of 1 July next.
So we've got a couple of questions here that we might pose these now. So Lee asks, what about where we have situations with trust deeds that have cover-all clauses? So in essence, that meet any changes to SIS and so forth. So what do you have to say, I guess, against that?
Take that trust deed to the court.
Yep.
And the court will throw it out the window, because you can't have an all-inclusive clause that says, look, let's not worry about what the legislation is going to be in 16 years' time. This deed will still apply. Sorry, the court the court looks for the document to relate to the specific issues at the time. And I mean, we might as well write a trust deed that says this trust deed adheres to all of the SIS and tax provisions. Sign here.
Yeah. Okay, that's good. So Adrian asks, is there any need to actually do the deed upgrade before or after the 1st of July 2017? Which I think is a really good question.
Before.
And I guess it's because there are things that need to be given consideration to right now.
Well, the transfer balance cap has to come into operation as of 30 June.
Yeah. And I guess and you made reference to it before. The clients will be, got to make sure, A, all the clients are signing it, but B, you want an effective date in respect to that deed as well. Yeah. So the other one here, Chris, a lot of deeds seem to have deeming clauses or some type allowing option A, option B, or wording to that effect, or any other type as agreed to by the trustees that allows under the legislation. Any comments on this type of deeming clause and how this might apply to the super reforms? So I think it's, in essence, you can do this, you can do this, you can do this, or anything else that the law allows, which kind of goes back to the initial question.
I go back to the comment that I made in respect to the...
for Leah.
For Leah,
Yeah. So
same applies.
Yeah, but there's a balance in there, though, isn't there, somewhere? Because you want to make sure that the deed is accommodating changes, but it needs to be somewhat flexible still, that if there are some unique circumstances or some circumstances that can occur without the fund potentially losing its complying status as being an SMSF.
Well, look, there are certain occasions, Aaron, where you have to specifically draft a deed and some clauses in the deed that are relevant to that actual fund itself.
Yep.
And by using what Chris has qualified here, just simply wouldn't apply. I mean, I'm not saying simply because I'm a lawyer I want you to upgrade your trust deed. What I'm saying here is if the funds are going to operate efficiently and have the ability to embrace the strategies that have been qualified, you've got to upgrade the deed.
Yeah.
If it's not in the deed, you can't do it.
Yeah, and that's why with some of the additional documents that get introduced with the deed, there's the ability for them to become a special rule, because that's where the prescriptive nature of what that decision is, in essence, builds the SMSF trustee document.
Correct.
because of that particular outcome the trustees want.
Correct.
Yeah. So Leanne, question here, with allocation of earnings, are you suggesting we can just choose to allocate earnings across a retirement phase or whatever? No, it's not. It's not saying that you just have absolute discretion in terms of it, but there are different methodologies that you might want to use. So what I'm talking about is that we might still specifically want to set aside certain assets to support the retirement phase pensions, even though for tax purposes they're prohibited from applying for tax exemption using the segregated approach. So because that 100% tax-free income stream is supported by 2 or 3 specific investments, the earnings in respect to that investment or investments are allowed to be attributed to that specific superannuation interest, and that can become critically important. Like I said, if you want to continue to grow a 100% tax-free proportioned income stream. So that's really what I'm talking about there. Yes, you could effectively look to reserve fund earnings and then look to credit out, but we also need to understand that there are concessional contribution cap issues with allocations from reserves that we need to also understand and adhere to. So,
Adrian.
So Dean here has asked, do I need to have registration to suggest a deed update for clients? As I don't set up funds or give advice, I haven't undertaken that registration. So do we need to be licensed to be able to give this advice on the recommendation? I guess that the question is always going to be whether the recommendation of the deed update is being directed at the trustee or the member. So the decisions in respect to the advice that you're providing to the member will need to come with being an authorised rep or having your own AFSL. However, why the deed, so if the decision is at the member level to, Ian, I recommend to you, you need to commute your income stream to comply with the $1.6 million cap. That is advice. What is not advice is the fact that to accommodate that, I need to, as a trustee of the fund, upgrade the deed. So if the direction of the deed upgrade is to the trustees of the fund, that is not a requirement that needs to be licensed, because in essence, the decision to update the deed is off the back of legislative change and will need to comply ultimately to allow for the member who has obtained advice to be able to obtain the outcomes that they want to get through that advice. So I actually don't believe that the deed upgrade itself is a financial product recommendation, because the directions in respect to it are to comply with the SIS and tax legislative requirements, and if that's directed to the trustees, then ASIC's guidance in November or December last year would suggest, therefore, that it wouldn't fall under any sort of licensing regime. I'd be challenged on that, but that's the view that I would take. The importance to distinguish between the member needs and the trustee needs there are critically important, however. Adrian, given that the ATO stats tell us that most SMSF balances are below 1.6, which are the most common considerations that the deed update requires changes to? So obviously reporting around those transfer balance caps is going to be important. You're going to obviously need to deal with eligibility requirements. So even though people are under caps, they're still going to be governed by caps. That's one of the most critical pieces here. Just because they're not over the cap doesn't mean that the rules of the transfer balance caps don't apply to them. And that applies with accumulation members. It also applies for retirement phase recipients as well. So these changes are at a wholesale level significant, going right back to as they were in the same substance in 2007. Mark here, hi Aaron, does the deed update only apply to new funds established after 1 July 07, or all clients established prior to or post need to have their deed amended or updated? So again, this is a concept of any fund that will need to comply with the new rules. So every superannuation fund that will be paying income stream, wanting to make contributions, all have to adhere to the provisions of transfer balance caps, will be subject to eligibility to make those contributions, may be subject to excess transfer balance amounts. So this is not something that is specific to new funds going forward. This is specific to individuals that need to comply with the new rules, which is basically every superannuant in Australia.
Correct. Every fund that's operating now needs to upgrade its deed.
Yeah. And we're talking about every single APRA fund in existence in this country.
Absolutely.
Will be updating their trust deeds to accommodate for these changes because of the operation of the fair and sustainable, the fair and sustainable rules. So that looks like it, folks. So we will finish on time. So thank you all for joining us today. Like I said, if you've got any other specific questions in respect to today's session about the deeds you have in your practice, please look to make an appointment. We'll be happy to have that conversation with you. If you'd like to find out more, just maybe subject to the number of funds you got and the solutions we have, again, please drop us a note, book in a time, and we'll be more than happy to have that discussion with you. But other than that, good luck. Hopefully you are busy. If you want to find out more as well, we do have our SMSF days coming up in April. But other than that, I wish you a pleasant rest of the day. Thank you, Ian, for your participation today.
Absolute pleasure.
And I look forward to seeing you at our next SMSF training session. Cheers.